we've been talking about dividends, risks, and rewards, and I told you something about interest, and I said something about yield. Okay, now I'm gonna expose you to two other risks that are associated with dividend investing and how to counter them exactly. Okay, so if you're just new here and you're watching this for the first time, this is the Young Investors Movement. My name is Lowami. I am a member of the ITTL group that produces just this content for you. Okay, so there is a just Facebook group down there. Just check it in the description if you're watching this on Facebook, YouTube, or Instagram. I don't know. So just when you click on that group, you enter into our Facebook group, and into our Facebook group is where we talk about all these things, investing. And personally, I just reply to people who just ask me some questions. Okay, let's get to the point. Dividends again. Okay, last time we talked about interest, how interest hurt companies, and how people shy away from dividends when interests are high, and how companies do not make money, and how you lose money to dividends. And we talked about yield, which is a very important formula for dividend investors. You need to know how much money are returning onto my investment. Okay, today I'm going to talk to you about two other things that dividends is stuck on. Okay, we talked about when you're into dividends, your money is safe. But now let's challenge that statement. Okay, every year when we are using these fiat currencies, I mean, when I say fiat currencies, this money that we exchange, that are in control of the central banks, every year this money inflate. Like the central bank inflates the money, and the money lose value gradually. Okay, so this is a problem, because when you have like 1,000 now, and maybe 1,000 buys a ticket to somewhere, okay, next year, if the currency is decaying by 5%, your money is 950. It's no longer 1,000. And yes, the note is 1,000, but in the ability of what it can pay, it's 950. And we're talking about here, we're talking money in terms of what it buys, like its purchasing power, than just the note, the paper, and the numbers. Okay, yeah, if you guys are into investing, you really need to separate these things. Money are not the papers, they are not the numbers written in the papers, they are what they can buy for you. Okay, so let's get to this. When inflation comes, your money loses value. Okay, so if a dividend is paying 2%, okay, and the currency is inflating at 3%, you're probably not getting a return on your money, because you're getting 2% on the money that lost value 3%. And you get it? There is a problem there. Okay, and let's think about it. The currency, like the Rwanda Revenue Authority, and these like, or internal revenue services, depends on the country where you're investing in. If they are just going to look at tax, if they are going to tax you, they don't look at the inflation. Okay, which means that 2% you made is subjected to tax. And somewhere, if you are an international dividend investor, you're getting double tax. Like, the Rwanda Revenue Authority might take 15%, as they say, and any other country that you invested in may take a certain percentage. Like the US takes 30%, and this hurts. Like, if you're invested in a dividend stock in the US, you're paying, like, if you calculate the net, like 15% in Rwanda and 30% in the US, you're getting something like 40, like, okay, actually considering that you pay 15% to what's remaining after paying the tax in the US, to what's remaining you pay 15% right here in Rwanda, you get a total of, like, you're paying 40% on your money into tax. Now, if you deduce that from the 2% that you earned, it's very big. It's like 1.2. You're remaining with 1.2%. And if you factor in inflation, you are at the end of the day losing money. Okay, like the stocks that you bought is no longer making you money, but you're losing money. But this is just away from our mind, like our eyes don't see this until we go into the deep depth of these calculations. I'm sorry if today's video just include more calculations, but we're going to compare two calculations to make sure we just escape this kind of trap or this kind of crisis or risk that is associated with dividend investing. Okay, so the first calculation that we need to keep in mind is yield. Okay, yield is all about how much money are coming to your money, like the 2% I said. To calculate yield, I'll show you the formula. Okay, you just take like yield. To see the yield, you just take the money that you are getting in dividends, like the money you're getting, like the dividend per share, you divide by the price per share you bought on the stock. Okay, it's not the current market value of the stock, it's the price you bought on the stock. Okay, like the purchasing price of that stock, and then that's when you get a dividend. Now we are going to be comparing the dividend with another calculation we call the break-even returns. Don't worry about this. You remember something called break-even point? When you made no profit and no loss and you're just standing in between, that's why we call break-even point. And when we're talking about returns, we also have a position that you can stand in. Factoring in all that inflation and all that tax, you stay like in the net, you make no money in the end, but you lost no money. So, as you understand, when we get like a yield higher than the break-even return, we are making money. If your yield is lower than the break-even return, you are losing money. Okay, now how do we calculate the break-even return? Factoring in the inflation and the tax rate. Okay, the formula is shown here. To calculate the break-even return, you will get the inflation rate in numbers, in percentages. You divide by 100 minus the effective tax rate. Okay, and the effective tax rate, if you are an international investor, it may be like 40%. We just take an example, and then what you get, you multiply it by 100, and then you get the percentage. Okay, you're always gonna need to stay above this percentage if to just be profitable. And when you go below that percentage, man, women, your money is not making any returns. Okay, so now let's take a real example of this. Okay, say the currency that you're working on is like London francs, US dollar, I don't know, whatever. It's like inflating at 4%. Okay, and then you're paying 30% in tax. Okay, now if you just apply the above formula, you will get 5.7% break-even return point. That is, if your yield is below 5.7%, you're losing money. If your yield is higher than 5.7%, you're making net money. Okay, so as you understand, we've been talking about the one rule of investing, that when you don't understand what you're doing, you lose money. When you understand what you're doing, you tend to make wise decisions that help you gain money. These are some of the risks that somebody who goes into something they don't understand, they are more likely to face these risks, without saying the major risks, like the company going bankruptcy, or the company like buying a company in a bad position. Okay, we're talking about the risks that nobody would ever see, and in this case your money will be losing. Okay, so you need to stay aware of the inflation rate. From this data will be displayed by the central banks, and you need to know about tax, like what tax are you supposed to pay on dividends, and then you need to know about the interest rate according also to the central bank, because these three things can hurt a lot your dividend portfolio. or they can raise it if they are, of course, to the minimum. Okay, thanks very much for following. I hope you just got a ton of value into this content, and when you are thinking about investing in dividends, you just need to be aware of these calculations, and hope you keep the formulas and you apply them everywhere. This, I told you, does not mean that every stock you see above 7, I mean above the break, who's just giving you a yield above the break-even return is worth a buy. You also need to analyze the stocks. And how do you analyze the stocks? You will look at their financial positions, like we call them fundamentals, the balance sheet, the income statement, and the cash flow. So you will read the annual reports of these companies, and you will visit more likely the investor relationship pages of these companies, and you will learn more about these companies. If you love one, and you see it's making money for you, it's not, you're not losing money in these hidden ways, yeah, then feel free to buy it. Okay, so thanks very much for following. See you next time.